This is ACC Amit Kumar, and now we'll discuss the standards which are beginning with the prefix IFRS. We've already discussed IFRS 1, first time adoption of IFRS, when we were discussing IS 8 accounting policies, changes in accounting estimates and errors, and how that the retrospective application which is applicable to IS 8 accounting policies is given some relaxation in terms of IFRS 1. And when we are presenting this third balance sheet, we are given some optional exemptions and we are given some mandatory exemptions. If we apply these exemptions, it becomes a facility for us to easily apply the change or converging to the new gap, and we need to present the third balance sheet of beginning of the earliest period presented. So we have discussed that this as part of IS 8 accounting policies because there is a relationship of retrospective effect with this. This is a facility given under IFRS 1. Now we will move on to discuss IFRS 2 share-based payments. So now we'll move on to discuss IFRS 2 share-based payments. IFRS 2 share-based payments is a standard dealing with what if we do not pay our employees and vendors in terms of cash, but we pay them in the form of share-based payments. Share-based payments, we give them equity shares or we give them cash payment that is based on the value of the equity shares. Now when we are paying them equity shares, that means any expenditure which is being incurred by the services provided by them will be forming part of P&L, and on the credit side we'll be creating an equity reserve. We'll be creating an equity reserve so that we can use this equity reserve to issue shares to these employees or vendors in futures. But if we base our liability on the basis of the value of the share, then depending on what is the fair value in the market, our liability will keep on changing. So that liability will be revised at the end of each year. So we'll be charging an expense to P&L account debiting, and we'll be creating a liability at the end of each year because that liability will be based on the fair value of the share in the market. So that liability will be revised at the end of each year because we do not know how much will be the fair value of that share in the market at the end of each year. So when we are issuing equity, on the date of deciding that we are going to issue equity, the fair value on the grant date becomes the total cost of the entity. So we have issued equity to them. Howsoever they fare in the market now is the responsibility of the owners will be owning these equity shares in the market when we issue them. So we create reserve on the basis of the fair value of on the grant date. If there is any change in fair value in the second year or third year or during this vesting period, we do not make any change in the total amount of expense of the entity with the change in the fair value of the share in the market, because the cost to the entity is based on the fair value on the grant date. But cost of the entity increases if there is any change in the liability. It may decrease as well because of the change in the fair value of the liability, because the liability is based on the fair value of the share. So equity settled transactions, we increase equity reserve. Cash settled transactions, there is a liability being recorded. Now when we have issued these shares, it may happen that they may not fare as expected in the market. So the vendors or employees may object to it that they did not get the value they were expecting in the market. So the entity will have to bear some additional cost, either by repricing the share, either by cancelling the shares, or either by cancelling a reissuance. When they're repricing or cancelling a reissuance, they are actually telling these stakeholders that we'll be bearing this additional cost. If they reprice the share, when they reprice the share, what happens? That any owner will be able to own these shares at a reduced price. So the exercise price, if it is suppose 15 per share, they may reduce the exercise price to 11 per share. Now, if they reduce the exercise price to 11 per share, means they are going to bear this additional cost. If they reduce the exercise price, that will result in increase in the fair value of the option. If it increases the fair value of the option, this reduced excise price will result in increase in fair value of the option, but there is an additional cost to the entity. This additional cost to the entity will be borne by the entity. So whatever expense they were recognizing till date, they'll continue to recognize, but this additional cost will be recognized over the remaining period when they do a repricing. So this additional expense will be recognized as an additional on the remaining period. They will not make any bifurcation in the first year, recognize the second year whenever this repricing is done. So whatever they were recognizing till date of their previous commitment that they agree to pay them this amount, that expense was being recognized over the initial period decided. But if they do a repricing, they agree to bear additional cost. This additional cost will be borne by the remaining period. If they enter into cancellation and reissuance, the reissuance will be done at a increased price. So if the fair value of the option was 5 and it has fallen to 1, they cancelled it and they reissued it at 7. If they cancelled and reissued it, they agreed to bear this additional cost of 6. If they agree to bear this additional cost of 6 is in same manner as we did for repricing. Because the shares continue to exist, whatever expense you have recognized is already recognized. So you need to bear this cost additionally. So this additional cost will be recognized over the remaining period. Now, what you need to bear for the remaining period, because that's the additional cost which you have, because you cancelled and reissued, means now this is the total expense of the entity which you need to bear for the remaining period. If you cancel it, whatever expense you were supposed to pay to these stakeholders, you have to pay it immediately. You have no choice now. It is not based on the fair value of the share. It is not based on the liability based on the fair value of the share. Whatever happens, now you issued this share-based payments, but it did not fall well, and in future you had to cancel it because the employees or the stakeholders did not agree to it. You had to cancel this because it did not fare as expected. So whatever work they have done or goods or services provided to you, you need to bear that expense, and you are bearing this expense, and the liability you need to settle immediately. So in case of cancellation, the expense is treated as an accelerated charge. Earlier you were able to spread this cost over the period, but now you do not have any choice to spread this cost. You have to charge it immediately P&L and settle this. This is all about IFRS 2 share-based payments. The next standard is IFRS 3, which business combination, which we'll be discussing as part of consolidation. So I'm moving on to IFRS 5, non-current assets held for sale. Now, as we discussed under IAS 16, property, plant and equipment, some property, plant and equipment we are consuming into the business, land and building which we are holding for capital appreciation or renting it out to others, inventories we sell in the ordinary course of business. What if you plan to sell any asset within 1 year? You intend to sell it. Now, if you intend to sell it, you cannot recognize some asset as per your wish that I want to classify it as non-current asset held for sale. It has to be immediately available for sale. It should be vacated. It should not be used in the current position to generate revenue or to produce goods or services. It is vacant, available for immediate sale, and the management is committed to sell. There is a plan to sell. You are advising to sell it. You are locating a buyer for selling the asset. The entity has no intention to change the plan. If you meet all these criteria, you can classify any asset as non-current assets held for sale. Now, on the date of classification, the requirement of IFRS 5 is that you need to remeasure it on existing measurement basis. Existing measurement basis means that it was either being measured at cost or either being measured at revaluation model. Whatever was the case, if it was being measured at cost model, on the date of classification, you need to remeasure it at cost model, means charge depreciation till that date. If it was being measured at revaluation model, you will charge depreciation till that date, but will also do revaluation exercise on the date of classification and will deal with the revaluation surplus, increase or decrease. Whatever happens, you enter into revaluation model again on the date of classification. Whether your existing measurement basis is cost model or revaluation model, you recalculate the value of an asset on the date of classification on existing measurement basis. Then, whatever is the carrying amount you get on the date of classification, you compare it with fair value less cost to sell. Lower of the two, you compare the carrying amount on existing measurement basis. I'm stressing on the point existing measurement basis, but this is very crucial for calculating the carrying amount on existing measurement basis. Depending on whether it was cost model or revaluation model, it is important. So be careful. Stressing the point so that you can take a note of it. When you have got the carrying amount and there is a fair value less cost to sell, record it at lower of the two. That is the initial recognition of non-current asset held for sale, lower of carrying amount and fair value less cost to sell. Subsequent measurement requires no comparison. Subsequent measurement is done at fair value less cost to sell. Do not be emotional that we'll be comparing it again. Subsequent measurement simply means that if the initial recognition was at 2,55,000 and subsequent measurement fair value less cost to sell is 269,000. So that increase in fair value will be directly recorded as part of P&L. If there is any fall in value, that will be recorded as part of P&L. If there is any increase, we are not comparing, will not be recorded at lower of the two now in subsequent measurement. It will be subsequently measured at fair value less cost to sell. Means if the fair value, if the initial measurement is at 2,55,000, subsequent measurement is as fair value less cost to sell. If fair value less cost to sell value is 269,000, means we'll be recording it at 269,000 now. Any difference taken to P&L. What if there is a change in the plan? We'll recalculate the asset value as if the asset was never classified as held for sale. If we recalculate the value as if the asset was never held for sale, we'll get the carrying amount as if this was never transferred to this category. We'll compare it with the recoverable amount because we are trying to recognize it back to normal. So on the date of deciding to changing the plan, we need to recalculate carrying amount as if this asset was never reclassified as held for sale, and will know the recoverable amount. Whichever is lower, now there is an automatic impairment when you decide to take back the asset into its normal category, automatic impairment testing happening here, and whichever is lower becomes the asset at which it will be recognized. Now if it is redirected back to PP, this lower of the two carrying amount will become the initial cost of PP, and on the basis of the remaining useful life will be charged depreciation in future. This is how if we change the plan. So this is all about IFRS 5, non-current assets held for sale. The next standard was IFRS 6, exploration for and evaluation of mineral resources. Exploration for and evaluation of mineral resources we should have discussed as part of IAS 38 intangible assets. If you remember research and development expenditure said that all the expenditure being incurred in the research phase will be expensed, all the expenditure being incurred in the development phase are capitalized. But in case of exploration for and evaluation of mineral resources, the mineral industry wanted that the moment they get the right to explore, they should be eligible to capitalize. Though there is no indication that how much of the resources will be available, but the moment they get the right to explore, they should be allowed to capitalize any expenditure they are incurring after they get the right to explore. So indirectly what they were demanding an extension of development phase. That in the research and development phase, they were demanding an extension of the development phase, that from the point, because they were not able to meet all the criteria of research and development expenditure of IAS 38, which was not being applicable to them, because if they would have used these principles, they would not have been able to apply the development phase. So what they demanded, that we want an extension, and from the date we get the right to explore, we should be eligible for capitalization. So any expenditure being incurred before they get the right to explore is expensed off. Any expenditure which is incurred after they get the right to explore will be considered as development stage and will be eligible for capitalization. This is IFRS 6, exploration for and evaluation of mineral resources. The next standard is IFRS 7. IFRS 7 is relating to disclosure of financial instruments. We discussed when we were discussing IAS 32 and IFRS 9 that any disclosure you are required to disclose, you'll be forming it as part of annual statements, your liquidity risk, your credit risk, sensitivity analysis, the disclosures relating to financial instruments, debt instruments, equity instruments, and your liabilities are supposed to be disclosed as part of the notes to accounts. So next standard is IFRS 8, operating segments. Operating segments was earlier known as IAS 14 operating segments, which had primary segments and secondary segments, but this was changed and withdrawn, and the new standard was known as IFRS 8 operating segments, which is similar to SFAS 131 US GAAP and was getting the guidelines in the form of management approach. So it says that whatever is being reviewed by the chief operating decision maker is of importance and should be considered as a reportable segment. So this standard says that we need to use management approach first. Whatever is being reviewed is of importance and should be considered as a reportable segment. Then we can use aggregation criteria. Aggregation criteria means if majority of the economic characteristics are matching for a product or a service, and like the place of distribution, the type of customer, the distribution channels, the geography in which they are located, if majority of all the economic characteristics are matching, we can aggregate them and club them and show them as reportable segments. Third, we use quantitative thresholds to determine the reportable segments. Quantitative thresholds are based on revenue, based on profit and loss, and based on assets. If all will identify all the reportable segments, and if any of the reportable segments are reporting revenue of more than 10% of total revenue, we'll classify them meeting the quantitative threshold criteria of revenue, and they will be considered reportable segments. If any operating segment is meeting the asset category, that is they're holding more than 10% of total assets of the group, then those segments will be considered as reportable segment meeting the asset category of quantitative threshold. Third category is for profit and loss. If all the operating segments are divided into how many of them are reporting profit and how many of them are reporting loss, we'll add up the total of all the operating segments which are reporting loss and add up the total of all the operating segments which are reporting profit. Whichever is higher in absolute amount, whether the loss is higher or whether the profit is higher, if it is representing 10% or more of greater of those amounts, whether loss is higher or gain is higher, will not need to be emotional. If it is representing 10% of total loss or 10% of total gain of all the segments which are reporting loss and all the segments which are reporting profit, whichever is higher, 10% of it is representing, then we'll identify some more reportable segments which are representing more than 10% of losses and which are representing more than 10% of profit are reportable segments. We further see that if there are any other operating segments which are meeting aggregation criteria. We can club more on the basis of majority of economic characteristics. Finally, we need to meet the 75% threshold criteria. That if the entity's total external revenue is representing 75% of total revenue, we have been successful in reporting the operating segments. If all the operating segments which are reportable are reporting more than 75% of entities' external revenue, we have met the 75% threshold criteria. But if the total revenue being represented through these reportable segment is below 75%, we need to report additional segments to make or to meet the 75% threshold criteria of total external revenue of all the reportable segments as against the total revenue. All other segments will be reported in other segments category, and this is how we present the operating segments or reportable segments. We disclose their revenues, we disclose all the expenses, we disclose the reconciliations of total assets, total liabilities, revenue, profit and loss, so that one can measure the reportable segments categories and how they were considered reportable. So this is all about IFRS 8 operating segments. The next standard is IFRS 9, which we discuss in financial instruments. IFRS 10 we'll discuss as part of consolidated financial statements. IFRS 11 as joint arrangements. IFRS 12 as part of disclosures of consolidated financial statements. So the next standard to be discussed is IFRS 13 fair value measurement. Now, IFRS 13 is the standard dealing with the definition of the fair value measurement. The fair value is the amount at which asset is carried in the books. The price at which a buyer is willing to buy, seller is willing to sell between market participants on the measurement date is the new definition of fair value. It is dependent on now three levels. Level 1 is the quoted active market. Second, level 2 is unquoted similar market. That if we have the market for cows, there is a quoted market for cows. But if we wish to measure buffaloes, we may not be having the value for buffaloes, so we can take the value from the unquoted similar market of buffaloes and can make some adjustments and can arrive at the price of those buffaloes. Level 3 is when we do not have quoted market, unquoted market, there is no benchmark available. Then the only option left with us is we observe the price. And value in use is one of the examples which we use as level 3 fair value measurement, that we forecast the expected cash flows and we forecast the expected earnings over the life of that asset, and we try to arrive at the value in use of that asset, which is termed as fair value for that asset. So fair value is market value. Market value is fair value, but fair value is not necessarily market value. It may be derived from level 2, it may be derived from level 3. I am summarizing with you all the names you will be encountering throughout your IFRS study or encountering in the examination hall. The purchase, so there are various amounts. So carrying amount is any amount. So when you listen, or when you read IFRS, you are being encountered with this word carrying amount. We compare the carrying amount. We compare the carrying amount with fair value less cost to sell. We compare the carrying amount with the revalued amount. The revaluation is done at fair value. So there's always a confusion. What is the difference between fair value and revaluation? What is the difference between carrying amount, net realizable value, net book value? So I am summarizing all of them together. So purchase price is the price at which you are initially purchasing it. If you continue to record the asset at the same price for all the years, you are continuing to record it at historical cost. You are not directly deducting the value of depreciation from this cost. So you continue to maintain historical cost by creating a provision for depreciation. If you are directly reducing the value of the asset from the purchase price, you are recording it at net book value. You are charging depreciation to the historical cost and you are not recording it at historical cost anymore. Value in use is your projected cash inflows discounted at present value. So what is the outflow from that asset? What is the inflow, projected inflows? And when you discount all those cash flows to present value, the net inflows is representing the value in use of that asset. Present value of net inflows. Discounted value is that if you plan to pay some amount in future after 5 years, what is the value today? If you have to pay in today's terms, what is the value today? You discount that cash flow in today's terms and that becomes a discounted value. Net present value is the value in today's terms. What if you have to pay that amount today? Net realizable value is what if you would have sold that asset today? What would have been the value you would have realized? Net realizable value is different in case of assets and different in case of inventories. In case of inventories, it is fair value less cost to sell, less cost to complete. In case of other assets, it is fair value less cost to sell. What you get if you are selling this and what is the cost of brokerage or any cost you are incurring to be able to sell this asset. Recoverable amount, as we discussed the standard on impairment, it is always higher of value in use or fair value less cost to sell. That is NRV. Fair value, as I discussed, is dependent on 3 levels: level 1, level 2, level 3. Market value is fair value, but fair value is not necessarily market value. You should keep this in mind. Revalued amount. Now there is a term being used as that we do revaluation exercise at fair value. That doesn't mean that there's not any difference between revalued amount and fair value. Fair value is the value we use to do revaluation. So when we get the revalued amount, it is based on fair value. So what is the difference between two? Why there is a new name? Because revaluation is not necessarily done at the end of each year. If something is measured at revalued amount, it is not required to be remeasured at the end of each year. If something is measured at fair value through P&L, fair value through OCI, fair value less cost to sell. This is the important tip. If anything is being measured at fair value model, fair value less cost to sell, fair value through OCI, fair value through P&L, it is required to be remeasured at the end of each year. Please remember, it is required to be remeasured at the end of each year. So revalued amount is slightly different from fair value because revaluation exercise may not be done at the end of each year. It is done with sufficient regularity, and there is no definition of sufficient regularity. Fair value through P&L, you are measuring it at the end of each year, taking the difference to P&L. Fair value through OCI, measuring at the end of each year, taking the difference to OCI. Fair value less cost to sell, you are comparing for either recoverable amount or if there is any change, you are charging it to P&L. You are comparing it with either cost in case of inventories. You are comparing with carrying amount in case of non-current assets held for sale. So depending on for what purpose you are arriving at its fair value less cost to sell. Cost model, you use historical cost. Fair value model, you measure the assets at fair value, take the difference to P&L at the end of each year. Revaluation, as I said, it is not done with at the end of each year. It is done with sufficient regularity. Current price is the price at which you are able to buy a similar kind of asset in the market. Replacement cost is, suppose there are two brothers and one of the brother is given the Mercedes which was 10 years old. The second brother was told that we'll be buying you a new one. Is it justified? So what we do, we go to the market, look for a Mercedes which is 10-year-old, same color, same type, and we buy the same Mercedes, so it is similar to it. That is the replacement cost of the asset. What if a similar asset having suffered similar depreciation is to be recorded? That is the replacement cost of the asset. Effective interest rate. Effective interest rate is the rate which is being used to charge interest expense in the P&L account. It is not the coupon rate. Coupon rate is the 10% convertible bond, 10% loan note. These are the coupon rates, the rate of payment or the rate of receiving the payment from the people you have invested money in. So effective interest rate is the rate which exactly discounts the net present value to zero and is the rate which is being used to record interest expense or interest income. Now depending on your amortized cost, now if you have given any asset and if there is any transaction cost, that will be added as part of your amortized asset. If you are borrowing money, if you have borrowed money 500,000, if there is a transaction cost of 20,000, that means your amortized cost will be reduced by this transaction cost and your interest expense will be measured from the balance left. In case of liability, the transaction cost is reducing your liability. In case of assets, the transaction cost is added to the cost of asset to arrive at your effective interest cost. So this is all about the summary of standards till IFRS 13. IFRS 14 is not part of the syllabus. We'll be discussing IFRS 15 and 16.
Thanks for watching. Do not forget to click the subscribe button and hit the bell icon. Do like, comment and share. See you next time. Subscribe and hit the bell icon.